Bigger downturn ahead. Joining me right now is Fadel Gheit, Oppenheimer senior oil and gas analyst. Fadel, good to see you. Thanks so much for joining us.
Good morning.
What's your sense on this move in oil down to 42 now?
Well, it definitely could go lower, but I still think that the upside is greater than the downside. Near term, this volatility will continue because there are so many issues nobody really can quantify. China, Iran, the supply situation in the U.S., politics. So all these things are going to factor in, and we're probably going to see oil prices at the current level for probably a few more months. But after that, I do believe oil prices will probably gravitate upward, not by much, but probably $1 per quarter for the next year or so.
Well, $1 per quarter, as you know, is not going to relieve the junk bond market issues with some of these oil and gas company balance sheets. How do you think about that within, when you say there's more upside than downside? Are you talking a buck here, a buck there, or are you talking $70, $80 oil?
No, I'm not talking at all about $70 or $80 oil. I do believe the new normal is going to be somewhere between 60 and 70. I do believe that $40 is not sustainable. But I also do believe the $95 oil or $100 oil is totally out of any question.
Okay.
I do believe we are going to see much lower oil prices longer term than we have been seeing over the last 2 or 3 years.
Now, when you look for a catalyst on the upside, I always tell our clients, my catalyst for oil to go to 70 again is quite simple. It's a Federal Reserve going to QE4. Do you have a catalyst?
Well, the catalyst, unfortunately, is going to be supply disruption in the Middle East. 1 or 2 million barrels a day taken off the market for a prolonged period of time could send oil prices significantly higher, probably between $70 and $80. Is it going to be sustainable at the $70 or $80 oil? Absolutely not. It's going to come back to what I would say a sustainable price, which basically balance supply and demand fundamental and allow shale production to grow, not by 15 or 20% like it has been over the last 5 years, but probably in the low teens.
Fadel, I guess my big question would be, where are we in the cycle of job cuts? Because as prices go down, these guys have really been cutting jobs and cutting investment, right?
Absolutely. This is the last thing that they want to do. They cut capital spending by almost 40%. It's not sufficient. Now they're going to cut headcount, and that is very painful. But when we see mergers and acquisition, the headcount is going to be much lower because when companies combine, they will have obviously oversupply of people.
Fadel, as always, great analysis from you. We'll see you soon. Fadel Gheit there, Oppenheimer, and we'll be right back.